What is up, YouTube? Tim Layton here, and welcome back to my YouTube channel. If you're new here, welcome to my YouTube channel, and thank you for coming. It means a lot. So today, as promised, we're going to get into stocks to buy now. The last 2 to 3 weeks, stocks have been beaten up very hard, but some certain stocks have been beaten up especially hard, and some unreasonably so. So today, we're going to get into my 5 top picks for stocks that are a steal at their current price. Let's get into it. Alright, so jumping right into this, I'm going to break this down into 3 parts. First, we got high risk growth stocks that have been especially beaten down over the last couple weeks. Second, we have lower risk value stocks that are going to do very well if the stock market continues this downward trend. And third, I got a bonus for you guys. You'll have to stay tuned to figure out what that is. Alright guys, getting this thing kicked off with the high risk growth stocks that I think are going to do very well. Starting it out is NIO, ticker symbol NIO. And if you don't know what NIO is, that's okay. It's an electric vehicle company. So you may be looking at your screen right now and going, Tim, what are you talking about? You promised me stocks that have been beaten up. Electric vehicles have done nothing but skyrocket. And normally, you would be right. However, there is a special thing about NIO that has really screwed it in the last 6 months. It is a Chinese electric vehicle company. Now, personally, I think this is more than a coincidence. But every single time electric vehicles have started surging, skyrocketing, China comes out with some FUD, throws some fear right into the market, and makes all Chinese stocks tank. Now, like I said, I don't think that's a coincidence. I don't know. I'm not a conspiracy theorist, but something's fishy about that. So because of all this Chinese FUD that's been thrown into the market over the last year, it means NIO is now down 63% year over year. From 1 year ago today to right now, it is down 63%, which also marks the 1 year anniversary of when EVs initially skyrocketed to the moon. That was 1 year ago today. But you might be asking yourself now, if NIO's down 63%, it must be a pretty crappy company, right? Can't be doing well. Well, you would be wrong. Deliveries from 2020 to 2021 are up 109%. They have doubled the amount of cars that they delivered. This year, they delivered 91,000 cars. Now, here's the kicker. At the end of 2022, third or fourth quarter, NIO Park is supposed to be finished. This is the production plant that they have spent all of their revenue. It is the reason they're not currently profitable right now, because they've spent all of this money building this factory. And at the end of 2022, it's supposed to be done and pick up production to 600,000 cars per year. Now, for reference, Tesla this year delivered 900,000 cars. NIO's currently trading at 1/20th the market cap of Tesla. There is so much room for this stock to explode. As of right now, they're only for sale in China and starting to expand into Europe. But by 2025, they plan to be in 25 countries, including the US. Out of 25 analysts, the median estimated price for NIO at the end of the year is going to be $58 per share. It is currently $23 per share at the time of this recording. However, in the next 3 to 5 years, I could see this thing being a 500, 600, 700% return. So if you want to know what I'm doing, I'm buying the dip. I already have 100 shares, I think at roughly $35 a share. So I might buy another 100. That'd bring my average cost to $27, $28 a share. That's pretty good. Now moving on to the second high-risk growth stock that I think should explode in the coming months to the coming years. That stock is ChargePoint. Ticker symbol CHPT. CHPT. Now, what is CHPT? What is ChargePoint? ChargePoint is an electric vehicle charging station company. Now, not only is it an electric vehicle charging company, it is the largest charging company in the world with over 30,000 charging locations worldwide And on top of the charging stations, they also have an app that shows you all of the locations of all charging stations. Now, over 75% of electric vehicle owners use this app. Now, on top of the app, on top of the charging stations, they also have home charging stations that you can install in your house. So this company, the largest charging station company in the world, has a current market cap of $4 billion. Now, here's one of the main reasons why this market cap is so low. It is not currently a profitable company, meaning they are not making a profit, and they're not expected to make a profit until 2024. But let me tell you why. Let me tell you why that's not a bad thing necessarily. The only reason, much like NIO, why they're not a profitable company yet is because they're putting all of their revenue into expanding the company. So by 2024, they will have charging stations in every city in the world. And once they are set, expanding to where they want to, they are going to be killing it. So this is another stock that I think 5-10 years down the line, when every new car rolling off the lot is going to be an electric vehicle, everybody's going to want to charge their cars in their house, everybody's going to be going to charging stations, this company is going to be massive. Now, if I break it down for you, this isn't a direct translation, but I like to look at this just to see where it could potentially be at. These are two different industries, but they have a lot of similarities. If you look at Exxon and Shell, these companies I think are trading at a $400 billion market cap, and they fuel all the gasoline cars on the road. So try to imagine in 10, 15, 20 years where these electric vehicle charging station companies could potentially be at. I'm not saying they're going to be at the same level. I'm not saying they're going to be a $400 billion company, but the potential is there. They have a lot of room to grow when electric vehicles take over the roads. ChargePoint is currently trading under 20% above the IPO price of $10.80. At the time of this recording, ChargePoint is at $12 a share. Meaning if you wanted to get into the electric vehicle infrastructure industry over the last year, but you said, oh, the prices are too high, I missed it, oh no, I'm not buying in now, this is your shot. This is it. You are getting in under 20% over the original IPO price of this company. When you look 10, 20 years down the line, you're not going to notice that $2 a share. When this thing's at $50 a share, $100 a share, you're not going to care that you got in at 12 instead of 10. This is a perfect opportunity. Now you want to know what I'm doing with this stock? I got 100 shares of it. I think at an average of about $24 a share. I will be buying at least another 100 shares of this, maybe even 200. Drop my average well into the teens, maybe $15, $16 a share. And again, my plan with this stock is 10, 15 years from now, when I look at that average cost of $15 a share, I am going to be so happy with myself because I believe I will have killed it again. All right, so now we're moving in to the lower risk value plays. Now these companies could do very well during these interest rate hikes and do very well when most companies are negative. These stocks could be positive. So the first stock is a bank stock, and this guy has been beaten down over the last week or two, and it is Goldman Sachs, ticker symbol GS. Now the reason this thing's been hammered lately when a lot of other banks have been doing positive is because Goldman Sachs did miss their earning target. Now Goldman Sachs is currently trading below all moving averages, 60-day, 100-day, 200-day, and if you don't know, the moving average is literally just the average stock price throughout whatever day amount you select. So 60-day moving average, the average share price over the previous 60 days. 100-day, 200-day, you get it. So stocks generally tend to trade within that area. And currently, Goldman Sachs is well below the moving averages. Another very bullish signal for me, the RSI, the Relative Strength Index, is currently at 25. Now again, quick rundown for you guys who don't know. The Relative Strength Index, RSI, it tracks momentum. It sees how many people are buying, how many people are selling, and it tracks it. So a number over 70 is a sign that too many people are buying it, the stock's getting too hot, and it's going to sell off soon. Now, a number under 30 means too many people are selling it and people are going to want to start buying the dip up real soon. So an RSI of 25 is a very bullish signal to me that this stock is going to take off very soon. Now, my last indication that this stock is going to do really well in the next couple months is the PE ratio. In the S&P 500, the average price to earnings ratio is 15. Goldman Sachs PE ratio is currently at 5, meaning it's 1/3 of the average PE ratio. So they are making a lot of money in their earnings, but their price is not currently reflecting that. Now, the last indication that makes me think this stock is going to do very well is the analyst estimated price for the end of 2022. The median price is $448 per share. It is currently trading at $335 a share, which puts it at a 33% increase. That is the median estimate, is a 33% increase. Now, for bank stocks, that is huge. You don't get that kind of return, potentially, out of a value stock very often. Now, the last stock that I think is going to do very well if the stock market keeps this correction trend going, and it's not exactly a stock, it is an ETF, and that is the S&P 500 ETF Trust, also known as SPY, ticker symbol SPY. Now, I don't normally push these kind of things. I always put it out in my videos. I always tell you guys what it is, but it's not really my style, so I don't normally hype it up. However, how much the S&P 500 and the NASDAQ as well have been getting beaten down make it a very good buying opportunity if you want to get into a really safe investment. The S&P 500 is currently trading at levels we've seen as early as May 7th of 2021, which was 9 months ago. So let's put that into perspective. Say you have a friend. Your friend started trading about 9 months ago. He's been making money. He keeps telling you about it, and he keeps telling you you need to invest. He says, come on, man, you got to invest. I'm making money. You can make money too. You can do it. Come on, buy in, buy in. And you go, oh, I really want to buy in, but the stock market's really hot right now. I don't want to lose money. Now is your time. As of this recording, the S&P 500 is down 11% from its all-time high. Now, in case you haven't watched my previous videos, the average S&P 500 return over the last 30 years has been 10.7%, meaning by buying in right now, you are getting a 1-year discount. Now let's stay hopeful here, stay positive. Let's say the Fed comes out and says for whatever reason they're not raising interest rates right now. This thing could easily shoot back up to its previous levels, and you could make a 1-year average return in a month, 2 months. Now, if the Fed does raise rates, which they probably will, the average stock market correction comes back within, I think, 4 to 6 months. I'll put that on the screen because I'm not exactly sure. But that means you could potentially make a 1-year return in the next 4 to 6 months by buying in now. Now, I'm not telling you to be stupid and dump all your money in right now. Don't do that. Put a good chunk in. If you're not invested already, put a good chunk in. And dollar cost average. Every week, no matter what it's doing, up or down, get in. You are getting a severe discount right now that could pay off long term. And the last investment that I think would be very good to jump into right now is not a stock. It is in fact a cryptocurrency. And that cryptocurrency is Ethereum, ticker symbol ETH. Now, if you don't know what Ethereum is, it is the world's second largest cryptocurrency, only trailing Bitcoin. Since November, it is down 50% from its all-time highs. In the last week or two, it is down like 30%. So, if just like my S&P 500 analogy, you've wanted to get into crypto, but you keep saying it's skyrocketed too much, it's went too high, I'm not buying in right now. Now is your chance. Fair warning, as cryptocurrency just fell 50% from its all-time high, it can fall another 50%. It can also shoot up to a new all-time high next week. Now, fair warning, it is a very volatile asset, and you need to take that into account when investing in it. You need to realize that it can drop 50%. So don't put the same amount of money in Ethereum that you would put into some value stock, because a value stock might fall 10%. A crypto might fall 50%, even 80%, and you need to be prepared to lose that money. As I said, right now is a huge discount, 50% from all-time highs. It is a great starting point to jump into. And if you're already in Ethereum, it is a great time to buy the dip, bring that average cost down. All right, guys, that is going to do it for this video. Those are my 5 investments that I think have potential to go very good places in the next couple weeks, couple months, or even couple years. As always, I am not a financial advisor, so please do your own due diligence. Maybe I opened your eyes to a new stock today. Do some reading on your own. Figure out if it's right for you before you invest in it. Don't blindly follow me. However, I hope I gave you some useful information that you can use to figure out if one of these stocks is right for you. If I did, please give me a like, please give me a comment, please subscribe, and I'll see you guys tomorrow.